Let's talk about the relationship between cost accounting and financial accounting. The relationship between cost accounting and financial accounting. We already know that financial accounting is a recording, classification, and analysis of financial transactions and the ascertainment of the financial position of a business entity. Financial accounting is a part of accounting that records actual transaction of an entity in monetary terms in accordance with established concepts, principles, accounting standard, and legal requirements, and present as accurate a view as possible of the effect of those transactions over a period of time and at the end of that time. It involves the recording of financial transactions of an enterprise as and when they take place and their financial inclusion in a periodical financial statement for the use of persons outside the business to assess the financial performance and position of the business. Let's talk about the differences between the cost accounting and financial accounting. As for financial accounting, the users are the management as well as the external stakeholders such as the shareholders, the creditors, the debtors, the tax authorities, investors, even customers, competitors. They need financial accounting information. Both the internal and the external users make use of financial accounting information. But as for cost accounting, it is only relevant and useful for the internal users, which are the managements of the enterprise. Looking at the objectives. What are the objectives of cost accounting? The objective of cost accounting is to provide information to aid planning by the management, to aid their plans, to make decisions, and to control costs. To cut costs, to estimate, to budget. Those are the aims of cost accounting. Financial accounting satisfies the stewardship function of management. That is, to account for the use of resources entrusted to managers. They have to account for the use of the resources because it is mandatory for them to account for the resources entrusted to them. Let's talk about the conformity to concept and standards. The conformity to concept and standards. As for cost accounting, there's no need to comply with standard or any concepts. No need to comply with any standards and concepts. But as for financial accounting, since the statement is needed by both the internal and the external world, it has to comply meticulously with accounting concepts and standards. Let's talk about the scope. Looking at the scope and forms of presentation. Cost accounting determined by management on the basis of relevance and cost-benefit consideration. While financial accounting determined by concepts, standards, and legal provisions. In the aspect of precision of information, how do I mean by precision? How do I mean by precision? Precision is how specific, how exact and detailed a piece of information is. Precision doesn't mean accurate or accuracy. Precision is more when we use precision is more valid than accuracy in the term of preparing financial information, because in data, in finance, precision and accuracy are often confused, but they mean entirely different things. When you talk about accuracy, accuracy is how close a piece of information is to the actual truth. But precision is how detailed the information is, or how consistency you can replicate the measurement. In accounting and financial auditing, precision relates to the materiality and granularity of the numbers. Financial information must have an appropriate level of precision to be useful. For example, rounding a company's annual revenue to the nearest million might be precise enough for a high-level executive report, but it lacks the precision required for a tax audit or an internal general ledger, where every cent must be accounted for. So when we talk about precision, it must be exact or detailed enough for the users. Precision of information in cost accounting can be approximated. Approximations are permitted due to uncertainties in making estimates, but must be sufficiently precise and accurate. While information must be more precise, I'll say it again, more precise. They are usually an audit by independent external auditors to confirm the reliability of information. Let's learn some terms in cost accounting so that we'll be able to understand the cost accounting statement whenever it is presented to us as a cost accountant or as an accounting student. We know that cost accounting is a specialized branch of accounting that focuses on capturing, recording, and analyzing a company's total production cost. What is cost? Cost is the amount of cash or cash equivalents given up to acquire goods or service that are expected to bring a current or future benefit to the organization. Now, now let's learn cost object. Is anything which a separate measurement of cost is desired. Cost object is anything for which a separate measurement of cost is desired. It can be a product like your smartphone, like your clothes, shoes, asset, etc. Or service like consulting projects, a department or specific business entity. What is cost unit? A unit of product or service in relation to which costs are ascertained is cost unit. For example, a cost unit could be per barrel for an oil refinery. It could be per kilowatt hour for an electricity company. It could be per passenger kilometer for a transport service, etc. Cost center. Cost center is a specific department or division or unit within a company that adds to the cost of the production of the products of an organization, but only indirectly adds to its profit. Example are the maintenance department, they are the human resources or accounting department, or research and development department. What is fixed cost? One of the terms we need to know in cost accounting. They are the costs that remain constant in total, regardless of changes in level of production or activities. Does not change, is fixed. They are the rents, factory rents, the insurance, the executive salaries, and the rest. Even if production drops to zero, those costs stay the same. They doesn't change. They are fixed costs. Variable cost. Variable costs. Variable costs are costs that changes in direct proportion to change in level of production or activities. Like when raw material and direct labor for wages changes. Maybe like increases by 20%, total variable cost will also increase by 20%. If it decreases by any percentage, it will also decreases by same percentage. These are the variable costs. Semi-variable costs, which is one of the terms that we're going to be learning, is also called mixed costs. Mixed costs are the costs that contain both fixed and variable components. They change with production volume, but not in direct proportion. No. A common example is the utility bill. A fixed monthly connection fee plus a variable charge based on actual consumption. Direct cost. These are the costs that can be easily traced directly to specific cost objects. I've told us what cost object is. Direct costs are the direct material, the direct labor, like that. Then indirect costs. Indirect costs. Indirect costs are the overheads. They are the costs that cannot be easily traced to specific cost objects. Instead, they are accumulated and allocated across various products or departments. They are the factory overheads, the administration overheads, selling and distribution overheads. Prime cost. Prime cost is the aggregate of all direct costs. All direct costs. The direct material used, direct labor incurred, direct expenses. They are the prime cost. When we say prime cost, they are the aggregate of all the direct costs. Conversion cost, like the name implies, is a cost required to convert raw materials into finished products. Total production cost. Total production cost is the prime cost with the factory overheads. Relevant costs. Relevant costs are the costs that are relevant in decision making. There are costs that are not relevant in decision making because some costs in cost accounting might based on past transaction. So all those past transaction, which is a past cost, cannot be useful in decision making for future purpose, for future costs. So we have what we call relevant costs. Relevant costs are the costs that differ between alternatives. It's only relevant cost that is considered to be useful when making decisions, business decision. Then this will make us to learn what is sunk cost. Sunk cost is the opposite of relevant cost. Sunk costs are the costs that have been incurred already in the past and cannot be recovered by any future decision. Sunk costs are always irrelevant to future decision making. Take for example, like money you spent last year, or money an entity spent last year on a market research report. It cannot be relevant for decision making. So all those costs are what we call sunk costs. Costs that's already been incurred and cannot be recovered by any future decision. They are sunk costs. They are irrelevant costs. We are still talking about the terms in cost accounting. Then we go to opportunity cost. What is opportunity cost? Opportunity cost is the potential benefits or revenue that is lost or sacrificed when choosing one alternative over other. For instance, if a company uses its warehouse for production instead of renting it out, the lost rent is an opportunity cost. The lost rent is an opportunity cost. Marginal cost. The cost of producing one additional unit of a product or service. It is primarily made up of variable cost. So, marginal cost is the cost of producing additional units of a product or services. Additional units. Job costing. This is used when products or services are unique, most especially when an entity produces in distinct batches, like construction projects, custom furniture, printing jobs. Process costing. Process costing is the procedure of costing a particular process of manufacturing a product of an entity. It is used when goods are produced continuously through a series of uniform steps or processes that result in mass quantities of identical products, e.g., the chemical manufacturing process, the cost of that process, the oil refinery, the cost incurred in the process, the food processing, the cost incurred is process costing.